U.S. Market Weekly Summary, week ending October 31st, 2025. This week, the Standard & Poor's 500 index made a modest yet noteworthy climb of over 0.7%. It was an exciting week full of earnings reports, a significant monetary policy announcement, and a pivotal China trade deal. The index wrapped up Friday's session at 6,840.20, boasting quarter-to-date gains at 2.3% and year-to-date growth surpassing 16%. Not too shabby, right? The so-called Magnificent Seven group, which makes up more than a third of the S&P 500, shared their earnings on Wednesday and Thursday. It was a mixed bag. Amazon, AMZN, led the charge with an impressive 8.9% hike, while Alphabet, GOOGL, and Apple, AAPL, followed with gains of 8.2% and 2.9%, respectively. On the flip side, Meta Platforms, Meta, took a hit, dropping over 12%, and Microsoft, MSFT, slipped by 1.1%, largely due to their hefty investments in artificial intelligence. It's interesting how AI is both a boon and a burden for different companies. Trade talks and interest rates, a busy week. On the world stage, President Trump and China's President Xi Jinping inked a one-year trade agreement. This deal is significant, as it involves China resuming U.S. soybean purchases and maintaining rare earth exports. In return, the U.S. agreed to reduce tariffs on China by cutting the rate related to fentanyl by half, bringing it down to about 47%. A big win for both sides, wouldn't you say? This agreement is expected to foster better trade relations and could potentially lead to more comprehensive discussions in the future, which is a positive sign for global markets. Meanwhile, the Federal Reserve decided to cut interest rates by 25 basis points. However, Jerome Powell, the Fed chair, kept us on our toes by suggesting that another cut in December isn't a done deal. The committee's discussions were lively, with differing opinions on the future direction. This keeps things exciting for us market watchers. The interest rate cut aims to sustain economic momentum amid global uncertainties, providing a buffer against potential slowdowns. Sector highlights: tech takes the lead. This week, the information technology sector stood out with a 3% gain, while consumer discretionary wasn't far behind, rising 2.8%. Not all sectors fared well, though. Real estate and materials saw declines of 3.9% and 3.7%, respectively. Within tech, Teradyne, TER, was the star, jumping 26% after exceeding Q3 expectations. Now, that's what we call a boost. The tech sector continues to be driven by innovation and the increasing reliance on digital solutions across industries. The consumer discretionary sector had Amazon as the top performer. The company's Q3 earnings blew past analysts' expectations, and Morgan Stanley anticipates even faster growth in Amazon's web services, thanks to expanding data center capacity and increased chip availability. In contrast, Alexandria Real Estate Equities, R, in the real estate sector saw a 25% drop due to disappointing Q3 results and a lowered full-year outlook. Looking ahead, what's next? Next week promises more earnings reports with companies like Amgen, AMGN, Uber Technologies, Uber, and Advanced Micro Devices, AMD, on the docket. Amid the federal government shutdown, economic data releases will be limited to those from private agencies, including October's ISM Manufacturing and Services PMI, Challenger job cuts, and the Michigan Consumer Sentiment Survey. It's a waiting game, folks. Investors will be keenly observing how these companies perform and what their forecasts indicate about the broader economic climate. As we look back on this week, it's clear that the markets are as dynamic as ever, with plenty of ups and downs to keep us engaged. Whether it's the tech sector's rise, the trade negotiations, or the Fed's interest rate decisions, there's always something to watch. Stay tuned, and let's see how it all unfolds next week. With so many variables at play, the market's journey remains unpredictable yet thrilling, offering endless opportunities and challenges for investors.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.